Hi guys, I'm AP. In this video, we are going to see what are all the risks there while investing in bonds. Okay, let's get started. To start with that, there are two main risks while investing in bonds. The first one is default risk and second one is inflation risk. Okay, let me explain. Okay, in the previous video, we've seen that what are the types of bonds available. It's mainly classified into government bonds and corporate bonds. In government bonds also, there are two types. One issued by RBI and another one issued by public sector companies. And in RBI also, there are four types of bonds available. The first one is T-bills and second one is the bonds which is issued on behalf of central government, and the SG is the bonds issued on behalf of state government, and the SGB, that is sovereign gold bonds. Okay, the default risk is nothing but at the worst case scenario, the company filing bankrupt so that the investors and the shareholders of the company make loss in that. In government bonds, the default risk is so low, but in the corporate bonds, the default risk is so high. Why I am saying that in government bond the default risk is so low means it's because the T-bills are a central government or state government or even public sector company bonds. The real owner or real promoter behind the companies are government. Okay, we are believing in the government and we are giving our money or we are investing our money. So that if we believe in the economy of the country which we are investing, then the default risk of the bond is so low in government bonds. But in case of corporate bond, the default risk is so high. If the company has a high debt or promoter takes some wrong decisions, then the company may file the bankruptcy, so that the default risk in the corporate bond is so high. Okay, to find out the default risk of the company, there are several rating agencies like CRISIL or ICRA or CARE. These are the rating agencies which have a professional investors and accountants who will go through the bond and the quality of the company, and they will give the rating for the company which is issuing bonds. Okay, now let us see. If the rating companies gives AAA rating means then it's a highest safety bonds. If the company is giving AA rating or A rating means it's a relatively safer bonds. If the company is giving the rating of triple B, double B or B, then the bond which has a slightly moderate risk. If the agencies declare the bond rating as C or D means then the bond has a very high risk in default. Okay, now we've seen about the ratings, and let me say that if the company has a higher ratings then which is much lower than the company which has some moderate risk and the default risk is so high. If this company is providing us let's say 8% of interest, then it will provide around 10% and it will even provide 12% interest for the bond which they are issuing. Okay, now we should be so careful while investing in the bonds. Even though our investing has a slightly low rate of interest, it's okay, but we should make sure that our bond should have a less default risk. If the bond has a higher default risk, then we should stay away from it. Okay, now let us see what is inflation risk. We all know that we are buying the bond in the face value of the bond. We discussed about what is face value in the previous video. Go check that out. Okay, now let us see the face value of the bond is, let's say, 100 rupees. Now we are investing it for interest rate of the 100 rupees face value bond is going to give us, let's say, 5% interest. Okay, and now in the inflation in the economy, let's say 4%. At the time we are investing in the bond which has the face value of 100 and the bond providing interest of 5%, the maturity date of the bond is, let's say, 5 years. Let us assume that if in the economy if inflation rises, now it is first year. Okay, in the second year after we are investing in the bond, now let's say if inflation in the economy, let's say it goes around 6%, and if we are planning to sell our bond in the secondary market in the second year after investing, now we never give that 100, we never going to sell that bond at the face value of 100. It's because at second year while the inflation is at the rate of 6%, at that year the public issue of the bond also will give the rate of interest, let's say 6%. But the bond which we are having and going to sell in the secondary market, we never sell at 100 rupees because the IPO price is offering 78%. How the investors in the secondary market will buy the same bond with the 5% of interest with the face value of 100? Now let us say if we reduce the face value to 100 to, let's say, 98, then the yield to maturity will rise, so that it will attract the investors to buy our bond. Okay, now if the inflation keep on rising, now let's say in third year, let's say our inflation rises to 8%, then if we are going to sell our bond at the third year which the inflation rises to 68%, then we cannot sell at the 98 rupees. We should even reduce our the face value of the bond, let's say 96 rupees, so that only we can sell it in the secondary market and have a exit option. But we should know that while the bond maturity of the fifth year, the bond issuer will pay us the 100 rupees face value. It is what written in the bond agreement. Okay, so that the investor can get the price appreciation in the face value as well as the 5% interest, so that in the secondary market for the investor it looks attractive to buy the bond. Okay, now let us assume that in the economy if interest rate falls. Now I taken the same scenario in which the face value of the bond is 100 rupees and it's providing 5% interest, and the maturity of the bond is 5 years, and the inflation in the economy the 4%. Okay, now let us consider that if in the economy the inflation is coming down. See, in the second year, it's first year, and in second year, if the inflation in the economy comes down, let's say 2%, at that time, the 5% issuing bond which we are going to sell, we not sell at the 100 rupees. We are going to sell that bond in face value, which is we are going to sell that bond with the face value which is much more than the face value which we are purchasing. It's because we are going to get interest 5% for the inflation of 2%. Inflation further falls to let's say 1%, then we are at the third year we are going to sell the bond with face value of face value more than this only. Okay, it's because inflation in the economy itself 1%, and the bond which we are selling which provides us 5% interest, so that it will attract the investor. Okay, but we should also know that at the maturity bond buyer from the secondary market will tend to lose money in the dropping of face value. It's because the bond issuer will give only 100 rupees at the maturity, but he can enjoy the 5% interest for the rest of years. Even though his yield to maturity will slightly come down, but while seeing the real return comparing with the inflation, his return will be much better than the IPOs which is coming at the inflation dropping years. Okay. Now let me explain the difference between the real return and the nominal return. Okay. Now let us consider we are our inflation in the economy is 6%, and the interest we are buying from a bond, let's say 8%. Okay, it is our bond interest, and interest in the economy is 6%, and our return is we should always our nominal return is 8%. Our nominal return is 8%, but our real return is nominal return minus inflation. That is, it is our nominal return and minus inflation. Our real return is just 2%. In the previous videos, we discussed about the Benjamin Graham's book, The Intelligent Investor. Earlier chapter itself, the Benjamin Graham mentioned the investors and the inflation. The investors who is seriously investing in the stock market or a bond market, he should always check what is the real return or the return which is adjusted after inflation. He should be concerned with that and he should invest in the economy. It doesn't make sense that if the inflation is at 8% and our bond provides 8% means our nominal return will be come to zero, but there is no sense of investing in that. We should always calculate the how much percentage of inflation is there in the economy, and we should tend to invest that at least 2% to beat the inflation to get a real return and enjoy it. Okay, we conclude this video by saying that we are seeing two main risks which is available in the bond investing. First one is default risk, second one is the inflation risk. In the default risk, we have categorized into two types of bond. First one is government bonds and second one is corporate bonds. We believe in the economy or a country so that we can invest in that. But if you are going to invest in the corporate bonds, then we should always check that what the credit agencies are giving rating about the company. We should never invest in the company which has low ratings. We should always make sure that the company which we are going to invest must have at least AAA or A rating so that it can have low default risk. Okay. The second one we have seen is the pricing in inflation risk. If we are going to invest in the bond, then we should fix that we are going to hold the bond until maturity. Then there is no worry for us. But if we are going to sell our bond in secondary market, then we should be little bit careful of price we are buying and how much price we are selling that bond. Okay. In the next video onwards, we are going to see about the some short history of capitalism and some basic term into the stock market. Okay, still then, stay tuned. Thank you.